Hello, I'm Jonathan Albano. I'm a partner with CCR Wealth Management. We're very happy to present to you our February market webcast. I'm joined by John Maher, Chief Investment Officer with CCR Wealth Management. John, let's just jump right into the topics that we prepared to discuss. February 11th, as of the taping of our webcast, can you discuss some of the differences in the capital markets today versus what we experienced in December and November of 2018?
Thank you, John. I think the differences in capital markets, certainly between now and December, I'd even say now in the fourth quarter, is an unmitigated reversal. We use the term, and you've read it many times in our outlooks going back years, we use the term reversion to the mean, right? Things get so out of whack in one direction or another direction, and you know that they're going to come back to some sort of some sort of medium. These are reversions to the mean are notoriously difficult to time, but we talked about really kind of a dislocation in prices, particularly in the third quarter as it pertained to the FANG stocks, right? Facebook, Apple, Amazon, Netflix, and Google, right? Just being solely responsible for pushing the market to new highs when the rest of the market wasn't really even participating. And you get into the fourth quarter, October correction followed by November and a December sort of a V-shaped bottoming that was largely illogical. So I think the market's also, however, queuing off a couple of real differences, and we could tick those off. One being Jerome Powell, Chairman of the Federal Reserve, has taken a much more dovish tone. Certainly a reversal from his October commentary, right? If you remember, he said in October, we're not even close to what they call the neutral rate, and then all of a sudden there was
Created the volatility.
Created a ton of volatility, created a bit of pessimism, and he reversed himself quite sharply in saying that they were going to all of a sudden be very patient with interest rates, taking his cue off the market, and maybe a sign of not being entirely comfortable with the role of being the mouthpiece of the Fed. The other difference, of course, between most of the fourth quarter and today is that we are actively engaged with the Chinese trade representatives, the Chinese government, in really what appears to be a legitimate, a concerted effort to hammer out a trade agreement. Go back most of last year, and it was tit for tat. It was quite a bit of, getting up from the table, walking away in kind of a huff. And even starting today, you mentioned what the date was. We have trade representatives in Beijing for what I think is maybe the fourth get together to really try to move forward on this trade deal. One last thing I'd mention, we talked a little bit about structural market issues, a little bit about algorithms, which I don't want to overemphasize that stuff, but Goldman Sachs put a report out about a year ago that does pertain to some structural issues in the market, and last year was certainly a year of record stock buybacks, right? And the Goldman report basically pointed out that corporate stock buybacks, corporate demand for shares is the biggest source of demand in the market. Well, if you're buying back stock, you can't buy back stock up to 30 days before you're going to be releasing earnings. So, there was a report they put out in, I think it was February or March of last year, that showed that, there is a statistically significant or at least meaningful influence when you may have some other negative influences of the market, but you don't have the demand of corporations able to step in to pick up shares because they have an earnings release coming up.
John, following up on that question, that subject, what are your comments on the earnings outlook that recently some of the largest U.S. companies have provided us? Okay.
So last month we wrote in our outlook, right, that we're watching certainly the Federal Reserve interest rates. We're watching China. looming a little bit larger, trade negotiations, and we also mentioned that what was sort of taking shape at the point that was going out was earnings, right? Because earnings are the real evidence of economic impact or evidence of economic assumptions made in the months prior. So today, a little bit more than half the S&P 500 has reported earnings, and from an earnings per share standpoint, about 70% of those companies have actually beat the earnings estimates, analyst estimates, by about 3.5% or better. Almost 2/3 of companies, I think it's 62%, have beaten the street estimates on revenue. So all those numbers are fairly positive when you consider the stock market being a leading economic indicator. When you consider what the stock market did in the fourth quarter. So let's bring up a chart right now that really gives us a kind of a sense. All right, so we're beating, at least most companies are beating street estimates, and most companies are beating on guidance. What we see here is guidance from corporations as far as earnings have been coming down for a couple of quarters now. We'll go back to sort of peak guidance back in July. So the beats are on lower numbers, granted. We also discussed that it would be important to take a look at companies' outlooks, right? So you report your earnings and then you give a view for 2019. And there the story is a little bit more mixed. So at this point in the earnings cycle, the reporting cycle, we see that for every company that is raising estimates for 2019, 2 companies have lowered estimates. So again, this guidance continues to be lowered, but I think it's important to note that in the midst of this negative guidance environment that we're in, that stocks are holding tough. I mean, we had companies beating, the majority of companies beating the street estimates back in October, and stocks were selling off. And now, not so much.
John, a subject that's on every investor's mind these days is Brexit. What are some of the themes that we should be watching for over the course of the next couple weeks, couple months?
I think maybe one of the themes is that I don't think it's on everybody's mind maybe as much as it should be. We did touch on Brexit briefly in our outlook, and we had also mentioned that March 31st is the deadline. Theresa May lost a historic vote last month, and she has, look at the calendar now, about 6 weeks to pull something together. Based on the size of that political defeat, that's a daunting task. We also mentioned that we were going to a dinner, market dinner, the CFA market dinner in Boston. David Cameron was the speaker. He's the former Prime Minister of the UK. We went to that, and dire consequences of customs backup and medical shortages in the UK and hard borders with Ireland. All that aside, he understands parliamentary politics much better than I do. So the takeaway from David Cameron's comments at the dinner were essentially that, number one, not a single member of the UK Parliament, according to him, wants a hard exit. Now that's true whether they're pro-Brexit or anti-Brexit. And so the other takeaway is that he places the probability of a hard exit or a hard Brexit, if you will, at 10%, no more than 10%. So Samuel Johnson, right, said nothing focuses the mind like an impending hanging. So we're hoping that sentiment or that kind of focus is taking place over in the UK.
John, can you compare and contrast economic and financial conditions today versus a year ago?
Today versus a year ago, sure. I mean, a year ago, look, to be really literal about it, a year ago the stocks were going down. Today, stocks arguably are holding tough, but they've recently gone up quite sharply from the December lows. A year ago, we had, I think, universally expectant higher growth. We're coming off a tax reform, and economic numbers were expected to be good. What we'll do is bring up the chart we showed last year, which, by the way, in this chart on the left-hand side is what we discussed in our webcast 1 year ago. On the right is simply an updated version of that. So a year ago we discussed, let's look at zoom in on these dotted lines, right? So the brown dotted line reflects the market expectations based on futures, and the blue dotted line is really where the Fed is in their forecasting. So this is last year's forecast on the part of the Fed and the market. And remember, a year ago, one of the big causes of the what ended up being the first of two market corrections was the shooting up of this brown line towards this blue dotted line, and that was based on positive economic data. Fast forward, let's look at the same exact chart 1 year later. This is as of January 31, and you see, again, zooming in on the brown dotted line, this is the futures market predicting where interest rates are going to be some years out. And you see we've gone from a concave, kind of gradually increasing expectation to more convex. And we have, according to the market futures, maybe one rate hike left this year. But then the market is looking actually at some rate cuts, if not next year, certainly in the next 24 months. So what that tells us is what we've been saying, right? So economically, things seem to be pretty decent here in the U.S., but globally, things are slowing. And the expectation of a possible rate cut would only be made by the market in a slowing economic environment. Evidence of slower growth is there. I mean, both central banks of the UK and the ECB, European Central Bank, have cut their own GDP forecasts a week ago. The U.S. is not going to be unfazed by slowing global growth. It will wash on our shores. The question is, to what extent? So our view continues to be that, yeah, we're still growing, but we're growing at a slower rate.
John, what's your opinion of the historical valuation on today's market?
Stocks are reasonably valued. They're actually cheaper than they were a year ago. So recall that in our outlooks and on a repeated basis, we try to get our clients to think in terms of valuation, in terms of a ratio, and distinguish between price and value. And I think the last 12 months has been illustrative of this whole process. All right, so let's go back and take a look at the chart. We see 18.1 times earnings, January 31, 2018. That's what the S&P was trading at. Fast forward 9 months when the market topped out in September, and you see actually the market had gone up, but the PE ratio had come down, 16.8. Kind of weird, right? The price went up. Market was trading near highs, near new highs, but the denominator, the E, earnings went up quite a bit. I mean, earnings are up as much as 20% in 2018. And then fast forward yet again to just this past January 31, and you see the price earnings have come down even more to 15.7. So my point being, now, these particular charts give us an idea of where the PE is now and what its either 15 or 20 year, depending on which one of these charts you're looking at, 20-year average has been. So even relative to a longer term history, stocks are reasonably valued. You can't say that they're cheap, but they're certainly not quite as expensive as they were.
So what types of things are we doing to our portfolios in February of 2019?
Well, one of the things that we have been engaged in the Portfolio Review Committee is actually making another tweak to our bond marks. And essentially what we're doing is reversing a trade that we had put on a year ago, and really as far back as 18 months ago. So what we're doing is really beginning to creep back up into a longer duration bond portfolios. Duration, we try to avoid using jargon, but duration is one of those words that kind of says it all. But just to spell it out a little bit more, duration is a measure of interest rate sensitivity of a bond or a bond portfolio. We're not as fearful of higher rates anymore. Refer back to the that concave outlook for interest rates going forward. And if in fact 12 months, 24 months, we're looking at lowering interest rates as the Fed and other central banks around the world try to engineer a soft landing. Well, that's going to be good for bonds. So last year was a tough year for bonds. We had predicted it would be. 0.06% rate of return on the Bloomberg Barclays Aggregate Bond Index. We did much better than that, with most of our bond portfolios, but clients are not jumping up and down about a 1% or 1.5% return. So that's one thing universally that we're engaged in, is seeking a little bit more interest rate sensitivity, as it looks like we are not at the end, but certainly nearing the end of this rate tightening cycle.
John, thank you so much for your thoughts and insight, and thank you to everybody who joined us today for our February webcast. Please let us know if you have any questions and comments, and we look forward to providing you future outlooks as well. Thank you very much.
Thank you.